Welcome friends. We have discussed in the video 1 about the zero coupon bond and bond fundamentals. And in the second video we have seen about the coupon bonds and their pricing and the YTM. We have done both formula method and through the spreadsheet model. Now uh, we'll discuss the kind of why the bond price normally changes, or the what are the reason of bond prices to change. So this section talks about, or this video will talk about, why bond prices change. Zero coupon bonds always trade for a discount. That is very clear because it is discount issued at a discount right now. You buy this, hold it. On the maturity, you get the face value. The difference between the face value and the discounted price is the return. So zero coupon bonds always trade for a discount. Coupon bonds may trade at a discount or at a premium. It depends. We have seen in the previous video, and I have shown you in the spreadsheet that when it will be premium, if the bond YTM is lesser than the coupon. For example, YTM 2%, coupon is 2.2%, then the bond will be at premium. If YTM is more than the coupon, 3% YTM, 2.2% coupon, then it will be a discount bond. And if YTM is equal to coupon, 2.2, 2.2, then it will be traded at a par. So these are the coupon bonds may be traded at discount or at premium or par. Most issuers of coupon bonds choose a coupon rate so that the bonds will initially trade at or very close to the par value, so that they need not go for a deep discount, as zero coupon bonds are very highly discounted. So most of the organization issuing the bonds, they try to attach a coupon with the bond so that it will be very close to the par value. After the bond issue date, the market price of the bond changes over time. That's the question now. Why the price of the bond changes over time? That is the question. So here we can say, and just I have shown you in this spreadsheet, that if the bond trades above par, we call it as above par or at a premium. If it is equal to the face value, we call it at par. If the bond is less than the face value, we call it as below par, or some analysts call it as discount. Why it occurs? Why normally this happens? If the coupon rate is greater than yield to maturity. Here we have taken an example. Coupon rate is greater than yield to maturity. Coupon rate is 2.20 and YTM is 2, then it will become premium. So that's the kind of thing. We can put a formula here. If this one is greater than this, premium, or it is discount. Similarly, if the bond coupon is less than the YTM, it will be discount. So it is written here, if coupon rate is greater than yield, it will be premium. Coupon rate equal to yield, it is par. Coupon rate is less than yield, it is discount. We have taken three examples. The coupon is 2.2%. If the yield is 2%, then it became a premium bond. If the yield is 2%, 2.2% exactly with the coupon, it is at par. And if the coupon is 2.2, yield is 3, then it became a discount. Now let us take an example to see the effect. Consider three 30-year bonds with annual coupon payments. All the three bonds are 30-year maturity, and all bonds are giving coupon at annual, once a year. One bond has a 10% coupon rate, one has a 5% coupon rate, and the third one is having 3% coupon rate. Only coupon rates are different. Face value all are having 100. YTM all are having 5%. Which bond trades at premium, which bond trades at discount, and which one at par? Now we can say, if the YTM is 5% and coupon is 10%, that will be a premium bond. First one will be a premium bond. YTM is 5, coupon is 5, second bond is at par. YTM is 5, coupon is 3, third bond will be at discount. Let us check it. So as we are from the beginning only, we are focusing on both the way. One is on the formula based, the other one is spreadsheet based. Formula based, you have all learned in your time value of money. The coupon one is an annuity, and the face value one is a single payment. Therefore, annuity formula is very simple. The cash flow divided by YTM whole multiplied by 1 minus 1 divided by 1 plus YTM to the power t. Annual means 30 year means 30, and we used the second part, that is the face value. Face value will be 100. It is like zero coupon bond, one payment at last. So 100 divided by 1.05 to the power n, that is 30 years. It comes 176. As we have seen, coupon 10%, YTM 5%, therefore it is a premium bond. Everyone will have demand for this because market interest rate is 5%, bond is giving 10%. So the demand for this bond will be high, it will be traded at premium. The second one is 5% and 5%. Premium coupon 5%, YTM 5%. Let us make the valuation. The coupon 5% of 100 is 5, multiply coupon divided by YTM is 5%, so $5 divided by 5%, whole multiplied by 1 minus 1 divided by 1 plus r to the power, or 1 plus y to the power n. So plus the principal payment end of the period, 100 divided by 1 plus y to the power n. It is 100 because the coupon is 5, YTM is 5, therefore it is at par. They are indifferent. Bondholders are indifferent for this bond because market rate is giving 5, you are also giving 5, indifferent. Third one is 3%, means 3% of 100 is $3 divided by YTM 5% multiplied by 1 minus 1 divided by 1 plus YTM to the power n, plus face value 100 end of 30 years divided by 1.1 plus YTM to the power n, comes 69.26. You see, the market rate is 5%, bond is giving 3%, no one will be ready to buy this unless otherwise it give a high discount. Therefore, it is traded at a discount of 69.26. So, suppose you purchase 30-year zero coupon bond with a yield to maturity of 5% for a face value of 100. The bond will initially trade for, we have done in the first video itself, zero coupon bond valuation is equal to face value divided by 1 plus YTM to the power n. So it became $23.14. So that bond will be traded at $23.14. That's why this is also known as zero coupon bond, is also known as deep discount bond. Very high rate of discount is given. What will be the price of this bond at 5% itself 5 years later? That means you purchased now, and after 25 years the price will be 100 divided by 30 years now it is. So you purchased at 23.14, hold it for 5 years, then again you make the valuation after 5 years. 100 divided by 1 plus YTM to the power n, n is 25 now, to 30 minus 5 is equal to 29.53. Now we can see the time value of money remains always same. The rate of return, the rate of interest remains the same. That's why time value of money goes down and down year after year. So 29.53, today's 23.14 is equal to after 5 years 29.53. Why? Because the inflation rate or the interest rate is 5%. So let us check it whether it is true or not. 29.53 after 5 years divided by 23.14 today to the power 1 by 5 minus 1 is equal to, you see, 5%. That means 5% is the interest rate prevailing in the market. That is your return. The same as the yield to maturity of the bond 5 years before. Note that the bond price is higher and hence the discount from the face value is smaller. When there is a less time to maturity, the discount shrinks because the yield has not changed, but there is a less time until the face value will be received. This example illustrates a more general property of bonds. If a bond's yield to maturity does not change, then the rate of return of an investment in the bond equals its yield to maturity even if you sell the bond early. That's the case here. Whether you hold it and sell it after 5 years at 29.53 or you sell it today at 23.14, the return remains the same. Why? Because the time value of money, today's 23.14 is automatically adjusted after 5 years, 29.53. And once the time passes, if you check after 10 years, the price will be more than 29.53. After 15 years, it will be still further. Like that, the time when it will be closer to the maturity, the price of the deep discount bond will be close to the face value because that time it is going to mature. After 30 years, the price of that zero coupon bond will be close to 100 because that time the money will, the principal will be repaid by the company, so there will be no discount provided that time. So that way, whether you hold it now, hold it 5 years, 10 years, your return will be always remain 5%, even though the price goes on up, increasing and increasing. So interest rate risk and bond price, if we see the effect of time on bond prices is predictable. The effect of time is very much predictable. If the bond is for 30 years, 30 years is the time the bond will be redeemed. After 30 years, the bond will mature. So time effect is very clear. On the bond, whatever is the time impact is clear and it is predictable. But what is unpredictable? The rate of market interest rate. That is unpredictable. So the market rate of interest normally affects the prices of the bond. Bonds with different characteristics will respond differently to change in the interest rate. Now the market interest rate change. Once market interest rate changes, the bonds with different characteristics will respond differently. For example, what are the characteristics we have seen in the very first video? For example, the bonds with different maturity will react differently. The bonds with different coupon rate will react differently. So the bonds with different time has a kind of pattern we will see now. Similarly, bonds with a different coupon will also react differently, we will see now. So bonds with different characteristics will respond differently to the changes in the interest rate. Investors view long-term bonds to be riskier than short-term bonds. Why? Because long-term bonds are more riskier to interest rate risk comparing to a shorter term bonds. If a bond of 30 years, bond of 5 years, if you see, the 30-year bond is more riskier to the interest rate risk comparing to the 5-year bond. How? Similarly, if you see the coupon rate, lower coupon rates are higher, more riskier to the interest rate risk than higher coupon bonds. So let us see. So higher, longer term bonds are more riskier to the interest rate risk. Similarly, lower coupon bonds are riskier to interest rate risk. Let us see with example. Consider a example number 6.8. Consider a 10-year coupon bond and a 30-year coupon bond. Dear students, here you have two different coupons are different. The years are different. Bond A 10 years, bond B 30 years. But both have a same coupon. Annual coupon is 10%. Understood now? So one is a 10-year coupon, the other one is a 30-year coupon bond. But the coupon rate is 10% fixed for both. By what percentage will the price of each bond change if its yield to maturity increases from 5% to 6%? Now, yield to maturity increase. If yield to maturity increase, bond price decrease. So now we will see if yield to maturity increase by 1%, both bonds are having same coupon rate, but the impact will be different on both of them. Why? Because the interest rate risk is higher for higher term bond, the interest rate risk is lower for lower term bond. Here lower term bond is 10 year, higher term bond is 30 year. Let us see. As for formula, we can see the 5% yield to maturity is 5%. We can see for 10-year bond, we can see for 30-year bond pricing. 138.61, 176.86. Now yield to maturity became 6%. Then the price, once YTM increases, price decreases. So for the 10-year bond, the price reduced to 129.44. But 30-year bond price reduced to 155.06. Now, how the percentage change? The percentage change for 10-year bond is minus 6.6. The percentage change for 30-year bond is minus 12.3. With the same interest rate decrease. Interest rate decreased by 1%. YTM decreased by 1%. But price, YTM increased by 1%, 5% to 6%. If YTM increased by 1%, price decreased by 6.6 for 10-year bond, 12.3 for 30-year bond. Therefore, higher the maturity, higher the risk. Lower the maturity, lower the risk for the interest rate risk. Let us see the spreadsheet, please, for this question. Yeah, here is the question. You can have 5%. The YTM is 5% here. 6.8. Yeah, here is the 6.8. You see, this is the 10-year bond, so N is 10. Annual bond, that's why N 10 means 10 years. The YTM was 5% earlier. Payment is 10% coupon means 10% of 100 is $10. Face value is 100. So using the present value function, we calculated the price. Now the YTM increased from 5% to 6%. Then the other things remains the same. The coupon remains the same. The period remains the same. Face value remains the same. Only YTM changes. Then price. YTM increase, price decrease. So from 138, price became 129. From 138, price became 129. Now the same we can see for, and what is the percentage change in price? 6.61. The percentage change in price is 6.61. Now let us see for the other bond, that is 30-year bond. Same, YTM 5%, 10% coupon, 100 face value. Using the PV function, price is 176.86. Now the same 30 years, but the YTM is 6%. Once YTM increase, price decrease. So price from 176 decreased to 155. This 155, we compare how much percentage decrease? 176 to 155, percentage decrease is 12.33. Here percentage decrease is 6.61. Therefore, the percentage change for the lower term bond is 6.61. For YTM change 1%. YTM change 1% change in YTM. 1% increase in YTM. How much percentage change in price? 6.61% change in price. For the other bond, 12.33% change in price. 1% increase in YTM, 6% decrease in the price for the bond 1. 1% increase in YTM, 12.33% decrease in price for the longer term bond. So which one is riskier? Obvious, the longer term bond is more riskier than shorter term bond comparing to interest rate risk, because we are checking the interest rate risk, how much percentage change in the interest rate and how much change in the price. So this is the way we can see the longer term bonds are riskier comparing to the shorter term bond for interest rate risk. Now consider a 5-year coupon bond and a 40-year coupon bond. 5-year coupon bond and 40-year coupon bond, 5-year annual coupon. This is a homework for all of you. Kindly do it. If you have any question, we will discuss in the next class. So 5-year coupon bond and 40-year coupon bonds are given. One is a shorter term, 5-year. The other one is a longer term, 40-year. But both have coupon rate same, 5%. Now, by what percentage will the price of each bond change if the YTM increase from 5 to 6%? Very simple. Here, one is a 5-year, one is a 5-year. So, the first one is a 5-year, the second one is a 40-year. And YTM increased from 5% to 6%. So once YTM is 5% and the PMT coupon rate is 5% here. The coupon is 5%. So 5% of 100 is equal to $5. You see, 5 years bond, 5% YTM, 5% coupon, the bond price is 100. When the same 5-year bond YTM increased to 6%, the bond price decreased to 95.79. Same 40-year bond, the price 5% coupon, 5% YTM, price is 100. When for the same 40-year bond, 5% YTM became 6%, the price became 84.95. Now we can see the percentage change. Here percentage change for 1% increase in YTM. 1% increase in YTM. For this 1% increase in YTM, the price of first bond decreased by 4.21% because it is only a shorter term bond, 5-year maturity. But the longer term bond, which is the 40 years maturity, see how percentage the price has been decreased. 15% price decrease because of 1% YTM increase. This is the way we can. So now I did this question for you. You can again go and practice. Any question, any doubt you will have, just let me know so that I can help you. Now we will have this kind of conclusion. Longer term to maturity, effect of interest rate risk is high. Higher coupon payment, then also interest rate risk will lower. We have seen one problem here. So first one, longer term maturity, higher interest rate risk. We have checked it with 5-year, 40 years. The previous question, 5-year and 40-year, we have seen that the 40-year bond is more riskier than the 5-year bond in comparison to interest rate risk. Now we will see two bonds, with one will be high coupon bond, the other one will be low coupon bond. Other things will remain same. We will change the interest rate. How the bond price will impact, let us see this. Consider two bonds, each of which pays semi-annual coupons and has 5 years left until maturity. See friends, here for both the bonds we kept the maturity same, 5 years. So that coupon we will change. One has a coupon rate 5% and the other has a coupon rate of 10%. But both currently have a yield to maturity of 8%. So both of them has a yield to maturity of 8%. By what percentage will the price of each bond change if its YTM decrease from 8% to 7%? So that's the question here. think this is not being done. Fine, no issue. We can do together. So here is the answer. One is a, see, both the bonds here, bond A and bond B, both are 5-year bond. Bond A and bond B both are 5-year bonds. Only thing is bond A 5% coupon, bond B 10% coupon. Yield to maturity decreased by 8% to 7%. And both the bonds are semi-annual bond. What we can do? We can go to the formulas so that whatever we have done the formulas, they will be copied here. And this one will be, we need also, let us make the same formatting so that, see, now we need to change the n now. Bond A, this is example, I think 6.9. Write down. So what is the data given there? 5-year for both the bonds and semi-annual bonds. So let us make the n 10. There is no change in the n. So n is kept as 10%. But 10 periods. Now IY previously was 8%, now change it to 7%. So 8% semi-annual means 4% 8% annual means 4% semi-annual, and 7% annual means 3.5% semi-annual. Same 4% and 3.5%. Payment is one, both bonds are having different coupons here. One has a coupon rate of 5%, the other has a coupon rate of 10%. Bond A 5% coupon. So if 5% coupon annual, 5% multiplied by 100 divided by is equal to, if the coupon is, for example, one is 5%, the other one is 10%, then the coupon for the bond A will be equal to face value multiplied by face value multiplied by the face value multiplied by the rate of return divided by 2.5. So face value multiplied by the coupon rate we will fix it as, okay. So same will be the case for this bond also, because same coupon, bond A we are checking. Bond B is 10%. 10% means that will be equal to face value multiplied by coupon rate divided by 2, and this will remain the same for the next one. So now check the calculate the pricing, please. When the coupon is 5% and this is 8%, the YTM is 8%, the price will be definitely 87.83, and when the YTM decrease by 1%, semi-annually 0.5%, the price increased from 87.83, it became 91.68. Same for the 10% coupon bond at 8% YTM, the price is 108.11. When the YTM became 7%, the price increased to 112. Now let us see where the percentage increase is high. You see here, in the case of the 5% coupon bond, the percentage of change in price is 4.38, whereas for 10% coupon bond, percentage change in price is 4.04. That means same 1% here, if 1% decrease in YTM, 1% decrease in YTM, the price has been changed by 4.38 increase in price, and here 4.04. So who is reacting more? The low coupon bond is reacting more than high coupon bonds. So this is the way we just this we have done through the spreadsheet now. 87.83 we have checked it, and all the prices can be calculated like that. Okay, little more, a little less, I will, yeah, now you can see the whole spreadsheet. So higher the coupon, lower the reaction. You see, higher the coupon, 10% coupon bond, price increase is 4.04, 5% coupon bond, price increase is 4.38. Whether increase or decrease, the impact of interest rate change will be more on low coupon bonds than high coupon bonds. This is what we have learned in the theory here. Now see the theory, higher coupon bonds, higher coupon payment bonds, the effect of interest rate risk is low than the low coupon payment bonds. We have checked here 10% and 5% coupons. And we have seen here the price is how the price is the change of price is more for low coupon bond, and change of price is high for change of price is high for low coupon bond, and change of price is low for high coupon bonds. And bond prices are subject to the effects of both passage of time and changes in interest rate. As I told you, the more the time passes and it goes to the maturity, close to the maturity, the price will be also very close to the par value, and that is because of the passage of time. And changes of interest rate, when the interest rate change also comes, price also changes. And we have seen both the characteristics, impact we have seen. What are the impact? If higher duration bonds, higher maturity bond, higher the interest rate risk. Lower maturity bond, lower the interest rate risk. We have seen the examples. Same like for coupon payment, for higher coupon bonds, interest rate risk is low. For lower coupon bonds, interest rate is high, just we have seen here. For lower coupon bonds, interest rate risk is higher. For higher coupon bonds, interest rate risk is lower, 4.38, 4.04. So these are the characteristics. Prices converge to the face value due to the time effect, but move up and down because of the changes in the yield. So these are all about the bond price change. Let me stop the recording, then we will take the question answer.